Welcome to Global Financial Regulation Updates. This week, I would like to discuss the progress of the implementation of the Basel standards in the European Union with you. As you will remember, in response to the global financial crisis, the Basel Committee for Banking Supervision introduced Basel III standards to address shortcomings of the pre-crisis regulatory framework, introducing radical changes to the methodologies for the determination of capital requirements. The final stage of the Basel III standards, which is referred commonly to as Basel IV by the industry, will be a significant challenge for the global banking sector. A recent article published in the Journal of Capital Market Studies, authored by Mete Feridun, a former Bank of England senior supervisor, and Alper Özün, regional head of asset and liability management at HSBC, discusses that Basel IV will introduce strategic, operational, and regulatory challenges for banks in scope. The article identifies a number of areas which are subject to further debate in the European Union, such as the enhanced due diligence requirements under the new credit risk framework, governance, reporting and control rules under the operational risk framework, exemptions for certain derivative transactions under the credit valuation adjustment framework, and the level of application of the capital floors within banking groups. As the authors quite rightly point out, global implementation of the reforms by all jurisdictions and transposition into national banking laws concurrently with the European Union in line with the Basel Committee's implementation timeline is quite important from a financial stability standpoint. Now, let's remember the highlights from the announcement of Basel IV by the group of central bank governors and heads of supervision, Basel Committee on Banking Supervision, several years ago.
Actually pleased and proud that we've come to this agreement here in Frankfurt today. The governors and head of supervision, otherwise called GHOS, met and endorsed the outstanding Basel III post-crisis regulatory reforms, called also Basel III Endgame.
There are many more constraints today than before the financial crisis. And there is good reason for that, because outliers in some instances became a problem.
Focus was on reducing the unwarranted variability in risk weights. In other words, avoid those situations which had happened during the crisis and after the crisis by some of these outliers who basically used their internal models to produce weights that would reduce their capital needs in a fashion that was considered imprudent.
If the objective of the exercise was to raise capital, it would have been a lot easier just to raise capital requirements, the minimum capital requirements, and was to reduce variability.
So the key policy lever is the output floor that basically limits the capital benefits that banks can obtain from the use of internal models. And this behavior in the past led to imprudently low levels of capital. Still much work to do, however, because this global agreement has to be now transposed into national law and regulations. And for this reason, the GHOS agreed about a starting date in 2022. So we also agreed to phase in the output floor over a period of 5 years.
And we also here talk about a fairly long gradual adjustment period. So in our judgment, all banks can actually adjust to what we have decided today.
Climate change poses new challenges to central banks, regulators, and supervisors. Integrating climate-related risk analysis into financial stability monitoring is particularly challenging because of the radical uncertainty associated with a physical, social, and economic phenomenon that is constantly changing and involves complex dynamics and chain reactions. Here is what Mark Carney, the former governor of the Bank of England, has to say about financial stability risks from climate change.
Climate change is an urgent and critical issue. It needs coordination, determination, cooperation, and consensus building. Given increased instances of extreme weather events and shifts in climate patterns, these risks have the potential to intensify in the foreseeable future. Therefore, addressing climate-related financial risks within the existing regulatory and supervisory frameworks has gained more importance over the last few years. Let's listen to what Bank for International Settlements has on its agenda.